They typically bounce back, producing a robust and rapid gain. The January effect is not withered away, but it has weakened. According to finance professor William Schwert of the University of Rochester, if you had bought small stocks in late December and sold them in early January, you would have beaten the market by 8.5 percentage points from 1962 through 1979, by 4.4 points from 1980 through 1989, and by 5.8 points from 1990 through 2001. As more people learned about the January effect, more traders bought small stocks in December, making them less of a bargain and thus reducing their returns. Also, the January effect is biggest among the smallest stocks. But according to Plexus Group, the leading authority on brokerage expenses, the total cost of buying and selling such tiny stocks can run up to 8% of your investment. Sadly, by the time you're done paying your broker, all your gains on the January effect will melt away. Just do what works. In 1996, an obscure money manager named James O'Shaughnessy published a book called What Works on Wall Street. In it, he argued that investors can do much better than the market. O'Shaughnessy made a stunning claim. From 1954 through 1994, you could have turned $10,000 into $8,074,504, beating the market by more than tenfold. A towering 18.2% average annual return. How? By buying a basket of 50 stocks with the highest one-year returns, 5 straight years of rising earnings, and share prices less than 1 point of Wall Street, O'Shaughnessy obtained U.S. patent number 5,978,778 for his automated strategies, and launched a group of 4 mutual funds based on his findings. By late 1999, the funds had sucked in more than $175 million from the public. And in his annual letter to shareholders, O'Shaughnessy stated grandly, "As always, I hope that together we can reach our long-term goals by staying the course and sticking with our time-tested investment strategies." But what works on Wall Street stopped working right after O'Shaughnessy publicized it. As Figure 1-2 on the enhancement shows, 2 of his funds stank so badly that they shut down in early 2000. And the overall stock market, as measured by the S&P 500 index, walloped every O'Shaughnessy fund almost non-stop for nearly 4 years running. In June 2000, O'Shaughnessy moved closer to his own long-term goals by turning the funds over to a new manager, leaving his customers to fend for themselves with those time-tested investment strategies. O'Shaughnessy's shareholders might have been less upset if he had given his book a more precise title. For instance, What Used to Work on Wall Street? Until I wrote this book. Follow the Foolish Four. In the mid-1990s, the Motley Fool website and several books hyped the daylights out of a technique called the Foolish Four. According to the Motley Fool, you would have trashed the market averages over the last 25 years and could crush your mutual funds if stocks in the Dow Jones Industrial Average with the lowest stock prices and highest dividend yields. 2. Discard the one with the lowest price. 3. Put 40% of your money in the stock with the second lowest price. 4. Put 20% in each of the 3 remaining stocks. 5. 1 year later, sort the Dow the same way and reset the portfolio according to steps 1 through 4. 6. Repeat until wealthy. Over a 25-year period, the Motley Fool claimed, this technique would have beaten the market by a remarkable 10.1 percentage points annually. Over the next 2 decades, they suggested, $20,000 invested in the Foolish Four should flower into $1,791,000. And they claimed you could do still better by picking the 5 Dow stocks with the highest ratio of dividend yield to the square root of stock price, dropping the one that scored the highest and buying the next 4. Let's consider whether this strategy could meet Graham's definitions of an investment. What kind of thorough analysis could justify discarding the stock with the single most attractive price and dividend, but keeping the 4 that score lower for those desirable qualities? How could putting 40% of your money into only one stock be a minimal risk? And how could a portfolio of only 4 stocks be diversified enough to provide safety of principle? The Foolish Four, in short, was one of the most cockamamie stock-picking formulas ever concocted. The fools made the same mistake as O'Shaughnessy. If you look at a large quantity of data long enough, a huge number of patterns will emerge, if only by chance. By random luck alone, the companies that produce above-average stock returns will have plenty of things in common. But unless those factors cause the stocks to outperform, they can't be used to predict future returns. None of the factors that the motley fools discovered with such fanfare, dropping the stock with the best score, doubling up on the one with the second highest score, dividing the dividend yield by the square root of stock price, could possibly cause or explain the future performance of a stock. Money Magazine found that a portfolio made up of stocks whose names contained no repeating letters would have performed nearly as well as the Foolish Four, and for the same reason: luck alone. As Graham never stops reminding us, stocks do well or poorly in the future because the businesses fooled into believing that it was a form of investing. In 2000 alone, the 4 foolish stocks, Caterpillar, Eastman Kodak, SBC, and General Motors, lost 14%, while the Dow dropped by just 4.7%. As these examples show, there's only one thing that never suffers a bear market on Wall Street: dopey ideas. Each of these so-called investing approaches fell prey to Graham's law. All mechanical formulas for earning higher stock performance are a kind of self-destructive process, akin to the law of diminishing returns. There are 2 reasons the returns fade away. If the formula is just based on random statistical flukes, like the Foolish Four, the mere passage of time will expose that it made no sense in the first place. On the other hand, if the formula actually did work in the past, like the January effect, then by publicizing it, market pundits always erode and usually eliminate its ability to do so in the future. All this reinforces Graham's warning that you must treat speculation as veteran gamblers treat their trips to the casino. You must never delude yourself into thinking that you're investing when you're speculating. Speculating becomes mortally dangerous the moment you begin to take it seriously. You must put strict limits on the amount you're willing to wager. Just as sensible gamblers take, say, $100 down to the casino floor and leave the rest of their money locked in the safe in their hotel room, the intelligent investor designates a tiny portion of her total portfolio as a mad money account. For most of us, 10% of our overall wealth is the maximum permissible amount to put at speculative risk. Never mingle the money in your speculative account with what's in your investment accounts. Never allow your speculative thinking to spill over into your investing activities. And never put more than 10% of your assets into your mad money account, no matter what happens. For better or worse, the gambling instinct is part of human nature, so it's futile for most people even to try suppressing it. But you must confine and restrain it. That's the single best way to make sure you will never fool yourself into confusing speculation with investment.